Hi, this is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Today, we're looking at Didi Global, which just recently went public, DIDI stock, and honestly, it's not getting a lot of love from Wall Street. So I'm wondering, is this potentially an overlooked IPO or an overlooked situation? Because you're looking at potentially a hyper-growth company at a very low multiple of price to sales. So we're like something like 2 times forward sales versus some of the high flyers that we've seen of many multiples. So we're going to talk about the valuation at the end of this video, but first let's take a look at what does Didi Global do to sort of understand what's going on here. And so as we take a look, you understand that Didi's mission is to make life better by transforming mobility. And this is a noble aspiration, as the reality is this is a global company predominantly focused on China, where you do have some, historically you've had challenges buying a car where it's either expensive or it's tough to get a license. And you also have special situations, whether or not you're a disabled person, or an elderly person, where, there's special circumstances around transportation. So this is ultimately solving a very core logistics problem that affects millions of users. So this really is a noble aspiration if you're able to improve the lives of tens of millions or even hundreds of millions of users. And the reality is this is a classic platform flywheel, where the more cars that you're able to get on the platform means the better experience that users will get. So more users look to get a ride hailing platform, to get a ride sharing, to get on the platform, and that results in more drivers coming online. So if you have more drivers, you don't have to do as many discounts, and it becomes self-fulfilling, self-reinforcing, where you ultimately get more and more people looking to catch a ride, or maybe an electric bike or something along those lines, and you have more and more vehicles coming into the marketplace. That makes this a classic flywheel example that ultimately does make it hard to unseat. You're only going to have a few players ultimately win this marketplace. And so you see they're building out a full suite of solutions, whether or not it's for taxis, whether or not you want to, hail a taxi, or you need it done in a timely way, express or luxury or chauffeur, or for enterprise solutions for businesses. So you get a lot of different shared mobility solutions. And they're also addressing what I'd argue is the full ecosystem around transportation. A lot of additional initiatives. For example, you have Piggy Express, which is a relatively new brand that they launched targeting younger, cheaper rides. So a completely separate brand from Didi Global. And then, you look at they have this partner leasing platform where effectively by working with Didi and their financing partners, you can effectively get 20% lower costs for leasing that car than if the driver decided to go directly to the leasing company. So it is big, there is some advantage to scale, you start thinking, for these drivers to work with Didi. And then you start thinking of partnering to building out a nationwide charging network for electric cars. Once again, they're considering all the angles here, which includes, China's initiatives to say, hey, we want more and more electric vehicles on the road in the years ahead. And as I mentioned already, this is predominantly a Chinese company. 90% plus of their revenue is from China. That said, they are expanding globally, and we'll talk about that in a second. And, more additional initiatives, looking at all this, the entire ecosystem around transportation, including food delivery, and saying, hey, you know what? There's a lot of different types of cars on the road. Let's custom build sort of a car specifically for ride sharing. So they worked with another top Chinese company, BYD, to build this purpose-built ride-hailing EV. So that, some people complain hey, the air conditioning's not right. Okay, so let's make sure that that's right. Okay, let's make sure it's small enough because it's going to be ride-hailing. So considering all these different aspects to build something that's addressing specifically the ride-hailing markets, it does reflect a level of thoughtfulness that goes into saying, hey, this is a big problem, and there's lots of different ways to look at it, including saying, hey, let's make sure the vehicles are right, which is really interesting to see. Then also autonomous, because who doesn't seem to have an autonomous company these days, where they're currently working on level 4 autonomous driving initiatives. And they also have a hitch platform, which you could see over here, which is this has been around for a few years. The idea is you're matching a car owner with a rider who shares a similar route. So this isn't about just, hey, carpooling with a bunch of people that are interested in going the same way. This is the driver was already planning on going here. Maybe they can sort of defray their costs, lower their costs of what were a route they were already expecting to do with Hitch. But look, if you're looking at a hyper growth company like Didi, it's not always going to go smoothly, and that might just be the understatement of the century, as in the last few years there were at least two issues known, where two women were murdered while using the Hitch platform, effectively, presumably male drivers picking up females that were going on the same route. So, this is not without hiccups. This does have some problems. That said, this happened several years ago, and the reality is, if you're dealing with a big enough platform, just the nature of mental health is you're always going to have a small percentage of the population with mental health issues that can result in unfortunate outcomes like this. And so, the question is, how big is the platform? And the reality is, this is a huge, big, and global platform. 493 million annual active users in the first quarter 2021, 15 million annual active drivers. So that goes back to the prior point that just a small fraction of these folks, if you get a 0.1% with mental health, that could result in severe consequences. So that's the reason why, they have made a point of sort of doubling down on their safety initiatives. They talk about how they have a SWAT team that can deploy anywhere in China the second there's a safety, something went wrong, so that way their team goes, sees what's going on. And so it's not only in China, but they're also expanding to other countries, into 16 other countries beyond China, 4,000 cities, counties, and towns. And so this is a big platform where the gross transaction value is 244 billion RMB, or 600 billion RMB in terms of income that's gone to drivers cumulatively from 2018 to the first quarter 2021. So this is a big platform when you think about this. And the reality is they are a ruthless competitor as well. When you realize that Uber, effectively one of the creators of this ride-hailing game, the ride-sharing game, effectively got beat out in China, was effectively forced to sell Uber China to Didi. So Uber does have a nice stake in Didi. And so this is a ruthless company. So when you start thinking about value proposition and competitive dynamics, you're thinking this is a company that's beaten out some of the other global players like Uber. And the reality is, a lot of investors are still expecting hyper growth in the years ahead, that they're just scratching the surface here. For example, the amount that's expected to be spent on shared mobility in China is expected to be many multiples in just the years ahead. Now, you obviously did have an impact in 2020 because of COVID and fewer drivers, but honestly, and fewer people looking to have a rideshare, but honestly, their downtick in revenue was actually very reasonable relative to what I thought it would be, especially if you compare it to something like Uber's numbers. So then, you look at their market potential that they're tapping into, saying like over time they're tapping into a $16 trillion opportunity size. So this is if you're able to win. And ultimately, as I already mentioned, you're only going to have a few companies that are able to deliver on this because of these flywheel effects of the platform, number of drivers, number of people going to the platform because the drivers are on that. So you could think, okay, there's only going to be a few players that win this over time, and they're tapping into this huge, enormous market opportunity, $16 trillion from a global perspective. And so you'd think this has a long runway ahead. So then the ultimate question is, what about the valuation? And this is pretty tricky to think about, and that's part of the reason why it just came public. So now, just a quick plug. My name is Daniel. You're watching Unrivaled Investing. If you enjoy learning about potential multi-baggers or types of stocks that potentially go up hundreds or even thousands of % over time, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey as I'm looking for potential multi-baggers each month, go to unrivaledinvesting.com. First week of the month, I call it my full portfolio, and then once a month, I call it a potential multi-bagger, one of these types of ideas that I think does have an attractive risk-reward setup. And, for example, recently I called out a stock that was trading below liquidation value that I think has 200 to 300% upside. So these are the types of situations that I'm looking for. And so, yeah, that's at unrivaledinvesting.com. And so then let's understand this valuation. And in order to understand the valuation, you do have to understand their financials. And as you look at their financials, you look at 135 billion RMB in 2018, growing to 154 in 2019. Obviously took a hit in 2020, and you can see how China mobility is the vast majority of this. So 141 billion versus 133 billion in China mobility. So China's the vast majority, 94% of their revenue. But the reality is this is just another hugely unprofitable IPO, and there's been a lot of them right now. So one should, if you can pick whatever you want to have in your portfolio, this is something to keep in mind, that this is another one of these hugely unprofitable companies, and that might, be part of the reason why the response from Wall Street has been rather lackluster so far. It's only been one day at the time of this video, but look, you have a company that you need to see a hyper growth response, ideally, because the reality is last year it got hit by COVID. So then it's like, oh, okay, well, maybe this grows a lot in the future. But still, based on looking at this business model, at least how they're reporting their financials, it's very, very low gross margins. You're looking around very low teens gross margins. Now that has gotten significantly better over time, from like 6% gross margin 2 years ago to 10% to about 11, 12%. So it is getting a bit better, but the challenge is on a operating basis, you're still burning several $billions a year, 10 billion plus RMB. And so this is a challenge. It does mean this business needs to scale significantly from here to think about what their long-term margins are. And so as we look at, thinking about this in terms of what's their potential valuation, as I look at this, I'm seeing, currently it's around $14 a share, and that's the ADS. Now the ADS does translate into ordinary shares, and so you do need to do that calculation. But all in, that's around $69 billion US dollar valuation. That translates to about 440 billion RMB valuation. And so, looking at that, effectively you're looking at a company, assuming they have a strong growth rebound in fiscal 21 of, let's say, 20 to 40% growth this next year. That effectively implies that they're 2 to 2.5 times sales. Now, keep in mind, there's a lot of companies coming public these days that have, much higher sales multiple. I've covered, like Doximity recently, or Sentinel One, where you're looking at companies that trade at 30, 40, 50 times forward sales. These are very different valuations, and the reason why you have companies with very different price to sales multiples is, and this is a key element that folks need to consider, is you need to consider the operating margins with these businesses. What do you think the operating margins for this business could be at scale? And so I think I'm being conservative here. I'm putting a range of optimized margins in the future of, let's say, 3 to 8%. Now, for full context, like right now, they're at around 11% gross margin. So that means they need to get some scale and pass on a lot of those costs, or lower those costs relative to their structure, to get to these margins. Now, it might be much higher over time if you think, maybe autonomous vehicles, and they're able to get some sort of share there, and they don't have to pay drivers as much, or some sort of angle of just getting to much material, much greater scale. And so that is a question, as you think about, making a call on this, then the question is, what's the ensuing growth rate in the years ahead? So the reason why it trades at this very low price to sales multiple is because the end margins are much, much lower than a lot of the other businesses that are coming public right now, that what are expected to be super juicy software companies, where the gross profit margins are something like 80% versus 10% for this type of business. So that is the delta. And so then you start looking at, okay, so what's the growth rate in the years ahead? And so this I could be, once again, I'm trying to apply a logical framework or a range here. I say 25 to 35% annualized in the ensuing years ahead. And so that's a ballpark range. You, of course, if you're making your own judgment call on this, you could apply, maybe higher margins or higher growth prospects, or even lower. It's a full range, and that's what I'm trying to do to see the picture here. And then what's that end multiple 5 years out that the market assumes? And I'm doing 15 to 25 times, because it's sort of saying, well, wait a second, let's actually see this play out. And part of the reason why I think I'm leaning towards more conservative side multiples on this is the functionality of that. There's just so much going on. Like, this is a whole ecosystem of products that you're trying to do. You know, you did get this COVID hit, so I want to see some growth for a year or two before saying, oh, okay, you've got this, you know, you're going to resume that. And of course, like, this is a hypothetical valuation framework. Of course, the stock price could go way higher or way lower. I think as I look at this, where I'm penciling out, you know, maybe 150% upside in my high case, which some could argue I'm being conservative, and like 64% downside in my low case, I think the stock price could go way higher or way lower. This is just my framework for how I'm considering it. But I think the key element here, as with a lot of these types of companies where you're just hugely unprofitable, is that it is so critical that they execute right now, this quarter and the quarters ahead. Because in order for investors to sort of buy into this idea that maybe this company has a 6 to 8% operating margin in the years ahead, it would need to see, hey, we are going to consistently improve our gross margins, we're going to execute and deliver, and this company is going to be much, much bigger and ultimately going to look differently at scale. So you're going to need to see that execution in order to get there. But at this point, it's just a little too early for me and my personal investment journey. That said, look, there are many different types of investors out there. There are venture investors that make a bet before there's even product market fit. So what I'm saying is I like to see the numbers start jiving a little bit more before I get confident. So right now, I understand why, you know, Didi Global has not gotten a lot of love from Wall Street. Personally, it's not far enough along on their journey for me to want to have it on my personal investment journey. So that's how I'm looking at it. That said, look, not every, you know, stock has to be super hard where you're saying, hey, what could their margins be in the future? You can try to find companies, potentially even Chinese companies like Didi, that still have, you know, reasonable or strong growth prospects and already have margins well penciled out. For example, I have called out on here a video on Alibaba where I'm effectively saying, look, you know, here's their margins, and I'm assuming their margins actually go lower over time as they diversify into different, you know, omni-channel initiatives. And so that's an example of a stock that in full disclosure, I do own some Alibaba stock. But if you want to find out more about the potential multi-baggers that I am interested in, you know, I am passing on Didi for now for myself in this personal journey. But if you're interested in, you know, what I am looking at, go to unrivaledinvesting.com, click on Journey for the potential multi-baggers. And if you have a different call on Didi, I'd absolutely love to hear it in terms of what you think I might be missing in terms of the marketplace. Maybe there's some upside here. Maybe there's some partnerships. Maybe you think their long-term economics could look quite different. I'd love to hear your insight. If you enjoyed this video, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.